Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss the academic research that has informed investing strategies over the past 90 years. Value and momentum, modern portfolio theory, efficient market hypothesis, factor analysis, asset allocation, and more. They cover everything you need to know to sound intelligent with your investment club. But the big picture is that all this knowledge won't increase your odds of beating the market. Even though many of these breakthroughs resulted in Nobel Prizes, as more investors flooded to adopt cutting-edge strategies, superlative returns became ever more elusive. It turns out some of these winning strategies do work some of the time, as theory would suggest. However, none of them work with sufficient consistency. Furthermore, it's likely impossible to identify the periods when a strategy will work as intended. In the end, you may be better off finding something better to do with your time and money than trying to outsmart the market. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening. And I'll probably have to change what I say at some point because I know I say this.
No. We should. I actually know a few podcasts where they say the same thing every time.
Okay.
And it's like it's a thing. It's now become a thing.
All right. If it's a thing, I'll stick with it. All right.
Okay.
Thanks everybody for listening.
We'll start over.
Is it a thing?
Yes, it is a thing.
All right, sure.
Okay.
I like a consistency. I just don't want to bore our listeners.
Okay. Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Last week, Trish and I had a lot of fun. Don't know how much fun our listeners had. It got a little wonky, little technical, very theoretical. But we had enough fun that we're going to do the same thing again this week. But instead of talking about economic theory, we are going to talk about investing theories. So this is one of those kind of big things you get reminded of every now and then, like the stock market does not equal the economy. So modern monetary theory was very economy and economics focused. Today, we're going to be focused on theories and kind of the resulting strategies when it comes to investing and just kind of the way history has worked out. Most of these theories are related to the stock market. So going back kind of prior to the 1930s, where stocks were starting to be sold, unfortunately, there was rampant fraud, just people selling stocks in companies that didn't exist. So Congress created the Securities Act of 1933 and the Securities Exchange Act of 1934 and created the Securities and Exchange Commission. And so the first time we had this federal regulation that forced companies to put together prospectuses. It had them create quarterly earnings reports and showing their financials, opening up their books and showing what their revenues were, what their cash holdings were. So all of the balance sheet and income statements that gave investors confidence that, at the very least, this company existed. We could actually see which companies were making money and which were truly frauds, and that's helped clean things up. So with both the kind of legitimization of investing in stocks, along with all this new data and information, we started seeing more and more theories on investing that were starting to build out from academic research based on some of the data that we were starting to accumulate. So we can start at looking at value and momentum, just kind of the idea that if you look at a company's financials, then the company that has, say, good cash flows and is profitable, but maybe the stock price doesn't reflect that, that might be a good value, a good stock to buy, where the counter might be no, because there's so much human behavior involved that the stocks that are doing well, because people like to buy things that go up, and just the way humans are, those will likely continue to go up. And those are more momentum and trend-based strategies. We get to the 1950s, we have modern portfolio theory. Then later on, we get efficient market hypothesis, and then some pretty good research on asset allocation. So that's going to be kind of the emphasis for today, is just some of the academic theories on investing, especially as it relates to the stock market, and how those have progressed over the last 90 years or so. So, Trishul, when you think of these kind of theories on investing, and especially starting with the value and momentum theories, what are some of the first things that come to mind for you from the beginning of where these started with?
Well, when I think about investing in general, there are two key decisions that people need to make. It's what do you invest in and when do you invest in said thing?
That sounds
And that,
familiar. I believe I've heard you say that before.
yeah, so I that's how I kind of titrate it in my mind. And really that's what this whole complex topic comes down to, if you think about it. But it turns out answering that question is a lot easier said than done. And there are many theories and lots of research, and there's been a pretty strong evolution of how this has all played out in history. So it's good to understand, where this all started and how it's evolved, and where do we kind of go from here, and what sense do we make of all this? So I certainly look forward to digging into some of this across this episode.
Okay, so if we start in kind of the beginning of these theories, so post 1934, what was one of the first ideas when it came to choosing what to invest in and choosing when to invest?
Well, the initial forms of investing were there were these stocks out there where you could buy portions of, and typically how it worked is you heard, oh, such and such invested in X, Y, and Z, and it did well. It returned a dividend or returned more money than the person put in. And, word of mouth spread such that more people got excited and they started piling on. And this is kind of what's known as momentum investing, where you kind of look around for the next hottest thing and you try to get in earlier before the next person, and you try to ride that wave as the stock gets higher and the company or firm does better and more people get attracted to it. Our early examples of this, you may have heard of, like the tulip craze that happened a long time ago, but there's been more recent fads like Beanie Babies and things like that, where you have this scarcity of a certain thing, like a security or tulips or stuffed animals, and people increase their demand for it because a lot of other people are increasing their demand for it, and it kind of piles on to the point where the value or price that people are willing to pay for these things go up and up. And this is one form of perhaps making a return. And early on, there have been shown evidence where this can make sense. But of course, what tends to happen with momentum type strategies is there comes a time when things become too expensive and then you have a bust.
Those are the examples I think of when I think of like the I think it's the Dutch tulips from the Netherlands. I think it was the best example of the first bubble.
Right. These are how bubbles kind of form by this pylon effect. But what the momentum investor tries to think is, well, I'm going to ride that wave and jump off before everybody else does. And I'm not going to be the one who's holding the potato when the bell rings. So that's kind of how it's supposed to work in theory. In practice, again, it's a lot harder to do than one would think. So that's the first class, momentum. But then there's this kind of contrarian notion of, well, if everybody's riding the thing that's going up, maybe I can do a bit better by thinking orthogonally or thinking a different way. And that's where this notion of value investing comes into play. So this was put forward by Benjamin Graham. Warren Buffett was able to pick up a lot of his notions from this individual. He was a professor, I believe Columbia in the 30s, and he wrote a book about securities analysis and selection way back in the 30s.
This is the guy Warren Buffett's listening to? And okay, now I'm paying attention.
Yeah, and this frankly got me interested in investing as well. And it also underlined my first initial philosophy on how I should approach the markets. And the notion that Graham tried to put forward is you have this market price where individuals in the markets decide what they should pay for something, but then you actually have what something is worth, its intrinsic value. And sometimes these two can be near each other, but sometimes they can deviate. Sometimes things can go out of flavor such that the intrinsic value is far below the market price, and that means it's a good buying opportunity. So you're not buying something because it's been going up like the momentum people. In fact, you're buying something that's kind of been kicked in the ground, something that's out of flavor, hoping that it'll go up. And what Graham kind of believed is even great companies will go through periods where they're not as liked. And that might mean a good opportunity to buy. So that's where value investing kind of got its roots. And it's been proven to be a good strategy for some people, like Warren Buffett.
Do you have a quick example or description of how he describes that intrinsic value?
Right. So there are ways to kind of think about it. But one thing is you can just look at the assets of the firm. You can kind of look at an accounting of these assets. It's known as the book value. And you can add up the value of these assets. And then you can say, okay, what is this actually trading for in the market? What does the market say the value of the actual firm is? And look for a big deviation. And it could happen that there is a deviation. You might also look into things in the company that are harder to price. For example, what is the brand name of Coca-Cola worth? There may not be a dollar amount, but it's certainly worth a lot because of its name recognition, one of the most well-known brands on the planet. So recognizing that there could be a value that's kind of locked away, that's not even there in the financial statements, is something that might be considered by a value investor.
That I think was one of the Warren Buffett stories I remember. He talked about how if you gave him $10 billion, he wouldn't try to create a product to beat Coca-Cola. That like there's no product or research that's going to do better than that brand recognition and just society's trust in that brand and the product they deliver.
Right. And the notion is if you can buy these companies at a significant discount to their market value, then eventually things will turn around and that value will be recognized. And you can outsmart the market that way if you keep looking for these opportunities. So that's where value investing kind of came into play.
Okay. So how did that work? Kind of, I guess that's the value part's still around. And in fact, I also know momentum's kind of still around. I was not aware that it was that old, but the way you described it doesn't particularly surprise me. Knowing that how long Warren Buffett's been around, that makes sense as well. So what was the next kind of iteration in academic research on investing after looking at the value of momentum?
Well, then about 2 decades later, there came this notion put forward by Harry Markowitz known as modern portfolio theory. And the theory here is that it's not necessarily about picking a stock that's the best value or the stock that's the best amount of momentum. In fact, you can do better through this notion called diversification by trying to maximize something known as your risk-adjusted return. So here's an important concept to understand in investing in general, this notion of risk-adjusted return. What we're talking about here is you don't only need to look at returns, but you have to look at risk as well. For example, if two stocks are expected to have the same return, but one has a lower risk, well, then you want to go with the stock that returns the same but has a lower risk. And then conversely, if two stocks have the same risk, you probably want to check out the stock that has the higher return for the same amount of risk. So just looking at returns on its own is not enough. It's necessary, but not sufficient. And then just looking at risk on its own is also necessary, but not sufficient. But perhaps if you look at both, something known as a risk-adjusted return, you can do a lot better. So one measure of this is you just take your return and you divide it by risk so that you get this notion of return per unit of risk.
Okay.
And try to pick the instruments that have the best returns for risk.
So if I remember correctly with modern portfolio theory, this also talked about the idea where with diversification and incorporating risk-adjusted returns, if you also incorporate the correlations between two or more stocks, like you said, they could have similar return expectations, even if they have the same risk expectations, so same volatility expectations. If they behave differently, then you can get this zigging and zagging effect where when one is going up, the other is going down, or at least one is outperforming, the other is underperforming. And by diversifying those at the portfolio level, you can actually get the same expected return of those two stocks, but the correlations have sometimes canceled out the risk of each other. And at the portfolio level, you can get an even better risk-adjusted return. Where the two stocks in my example, they both have the same expected return, so we still get the same return of the portfolio. They actually have the same level of risk, but by combining them with if they have a low correlation, our portfolio has the same return as both stocks, but less risk than either stock individually.
Yeah, that's pretty neat because now you're getting a higher risk-adjusted return by not picking between the two stocks, but just putting your money in both.
So it's not even trying to find the stock that has the better risk-adjusted return. It's just using multiple stocks to reduce your risk, to reduce your risk or improve your return, at the very least, improve your risk-adjusted return.
Right. And we mentioned this in a previous episode where if you look at the risk of a particular stock, it has two key components, something known as idiosyncratic risk and something known as systematic risk or market risk. So idiosyncratic risk is the risk of that particular stock, something happening to that particular company, like that CEO gets hit by a bus or that product gets obsoletized by another company.
I like how you verbed obsolete, past tense verbed obsolete.
Right. We'll figure out if that's an actual word, but the notion is any particular company is open to specific risks that that particular company has that may not be relevant to all companies in general, and that's idiosyncratic risk. However, that company also is open to risks that do affect a lot of companies, general market risk, meaning situations that can affect all of us, like the economy tanking and war starting and things like that. So these two components of risk are there, but by diversifying, meaning spreading your bets across many different companies, you can reduce that idiosyncratic risk that you're taking for a given company by spreading, again, that risk to many firms out there. And the more companies you add into this bucket, the lower the idiosyncratic risk gets, the higher your risk-adjusted return can potentially be, such that you're at the point where you can potentially kind of stamp out that idiosyncratic risk, and you're just left with that market risk with enough diversification. So that's what modern portfolio theory is saying. With enough diversification, with enough stocks that are zigging and zagging, you're kind of canceling out the inherent risk of any individual stock going bust, and you're kind of maximizing your risk-adjusted returns from that standpoint.
Okay, so the two so far what we discussed, the two big benefits of diversification based on modern portfolio theory is one, when we have stocks with similar risk return characteristics but low correlations, just adding those keeps the same return expectation, but reduces the risk of the portfolio. And we've reduced that idiosyncratic risk, that risk of a single company underperforming dramatically due to something that has nothing to do with the economy or the rest of the market. So modern portfolio theory and diversification has shown at least these two benefits, and both improve your risk-adjusted return.
Yeah, and then it goes just one more step further, meaning you can also, if the risk-adjusted return is kind of acceptable to you, but that return is too high because the risk is too high, you can lower your risk and keep a similar risk-adjusted return, or you can still maximize your risk-adjusted return, but lower your risk and your return to something that you're more comfortable with by adding a uncorrelated asset class. Like instead of being 100% stocks, you can be 70% stocks and 30% bonds. So this way you can still try to maximize your risk-adjusted returns, but if being in 100% stocks is too risky, you can still have an efficient portfolio that's slightly less risky.
Okay, so just by adding some bonds, you might be able to either keep the same return and reduce your risk. Like that's, yeah, that probably makes you get a similar return, or at least a better risk-adjusted return. So maybe your return goes down slightly, but your risk goes down proportionally greater.
Right. Another way to think about this is there's a spectrum here of first being 100% in stocks where you're pretty risky, and second being 100% in bonds where you're least risky. And then you can be any proportion in between. But along that curve of 70-30, 60-40, 50-50, 30-70, 20-80, and then 100% bonds, along that curve you have these different allocations to stocks and bonds, but each of those portfolios, if it's well diversified, gives you the maximum risk adjusted return that you could have by investing in those two asset classes.
Okay. That does, I can see why Markowitz won the Nobel Prize for that.
Yeah, it's pretty groundbreaking, and it's called modern portfolio theory, but it's 70 years old, but it does change things quite a bit from saying, I'm going to try to figure out which stock is the best value or which one is the best in terms of momentum. It's saying, no, you don't need to worry about any of that. If you do this, you will actually do pretty well, according to the theory. Now, we'll talk about what the evidence says, but that's what the theory says.
Okay. So moving on from modern portfolio theory, what was the next iteration that started to look at, again, investing? If we're focusing on diversification over choosing individual stocks, what's the next kind of investing theory that was as groundbreaking?
Well, now we're probably jumping another 2 decades later to the seminal work of Eugene Fromer. And the work he put out was related to this notion known as efficient market hypothesis. So this kind of goes one step forward of saying that, yes, you can do value momentum investing, or you can have this diversified portfolio as put forward by modern portfolio theory. But it turns out that if you do try to do security selection, you're up against a pretty steep wall. And he tried to provide a theoretical background on why trying to pick a stock is so challenging. And that's where his efficient market hypothesis started to take root.
Okay, do you mind elaborating on that?
Sure. So he had many forms or tests where the first form of efficient markets was known as a weekly efficient market. And what he tried to say with a weekly efficient market is all information about the past history of a stock was already kind of embedded into its price. So even at this weak level of efficiency, you can't use the past price information to figure out what to do next. So basically, it put a big X on momentum investing, where momentum investors would look at the past patterns of prices and say, look, it's going up. There's a trend here. It's going up more steeply than it used to before. Therefore, I'm going to buy. Or, other types of trend investigating strategies might be, oh, look, it's gone up so much that it's going to revert. Well, again, you're just looking at price information and you're looking for a pattern. And what efficient market hypothesis said in its weak form from Eugene Farmer was that even in this weak state, it's not enough to figure out what does better. The markets are efficient enough to say that you can't use past charts to figure it out. And at a high level, he's kind of saying this because if everybody's looking at a chart and everybody's trying to figure out whether something is going up, well, if it's obvious from the chart and you can see it and it's gone up and you're going to buy it, well, then all of a sudden it's not cheap anymore. It's already gone up. And all of these different types of strategies should go away if you have enough market participants trying to follow these same types of rules and heuristics. So that was the first form. And then Eugene Farmer said, well, there's more efficient markets out there that are known as semi-strong markets. And here is where, in these more efficient markets, that kind of value momentum might get the axe. And the notion here is there's other types of information that people may look at beyond just looking at the price charts. They might actually look at the fundamentals of a company. They might look at those financial statements and try to figure out if there is a good amount of value within a company. That intrinsic value notion we mentioned with Graham. And what Eugene Farmer is saying with semi-strong efficient markets is that you can't even use this information to make a good prediction on whether a stock is priced efficiently or not. And he's saying this because let's say you did do this calculation of intrinsic value and you looked at this information from the public financial statements that are out there. Well, guess what? Everybody else can find that same information and do the same math. Math is math. Mm-hmm. And the point is, if everybody's doing the same math and discovers this mispricing, well, what is everybody going to do? They're going to buy the stock so that it's not cheap anymore. And there goes your higher expected return, or there goes your benefit of doing all this work. So
this sounds like it there's a little bit of understanding arbitrage and just having enough participants, and like there might be a little bit of speed of information lag. But I remember when there were different exchanges far enough in the past where a stock might trade at one price on one exchange and at another price at another exchange, someone who could kind of be aware of that could buy that lower price and sell at that higher price immediately. And there was this arbitrage opportunity. And as soon as that happened, then they leveled out. And so kind of, as soon as you had enough people looking for these arbitrage opportunities, like you said, almost as soon as the opportunity is found, then the opportunity is gone. That right. It almost sounds a little bit like quantum mechanics, a little bit.
Kind of, but this was in the 70s when Farmer put out this paper, but you can imagine how what you just explained could be very well true with computers these days.
Yeah.
I mentioned before, computers can look at charts and they can look for patterns a lot better than humans can. And they can do it 24/7, real time, tick by tick, with more horsepower than you can think of. Computers can also read financial statements these days, and they can figure out what's going on with the intrinsic value of any company in real time the moment those financial statements get released, and they can process those information and make a trade before your email can load telling you that the earnings release is out the door.
Okay, so in the 70s, there might have existed an arbitrage opportunity that maybe one person can get, but then the following 100, it's already gone. So you have like a 1% chance. Now, the arbitrage opportunity is not available to human beings.
That's certainly what I believe. I believe that there's enough competition and enough horsepower and enough machines out there that it's quite challenging to take advantage of these notions. Okay, so now we mentioned the weak and semi-strong form of efficient markets. Pharma put forward one other form of efficient markets known as the strong form. So there's one more class of information that people could have traded on in the weak and the semi-strong efficient markets. And this is actually information that's hard to get by, but it's certainly possible to trade on. And that's insider information. So yeah, this is information like if you're the CEO of a company and you know what the earnings are going to be before they're released, and you know it's going to be good, well, you could go up and buy the stock. And also, you know that the earnings are going to be bad before it happens, so you could dump that stock. Now, it turns out that's illegal, but it is possible for inside information to leak out without people getting caught, perhaps. And if markets allow this information to get leaked out and people make trades on it, well, then people could make money. Well, what the strong form of efficient market hypothesis is saying is that markets have already even priced in this insider information so that you can't even make money on that, meaning little leaks happen here and there to the point where whatever information is supposed to get released is already kind of known by the market, either extrapolated by people doing kind of forensic analysis on what's going on with a company, or just people inadvertently or subconsciously trading the company based upon what they, in quotes, should not be trading on. But either way, all of this is already priced in, so it's a fool's errand to even use insider information to trade the market. So at the end of the day, there's a big X on even this. So even now with strong form efficient markets, which is likely what we have today, you can't use any information, public or private, or look at any chart or look at any type of financial statement or fundamental information about a company to make a decision. It's all already priced in. There's no point in trying to pick a stock or select a particular security. That's what Farmer was getting at.
Okay, this one I do want to explore a little bit more. So some of the thoughts that come to mind are we still see jumps up or down upon quarterly earnings releases. And it's usually with respect to expectations versus resulting financials, usually on the scale of earnings per share. That's the main number you see in any kind of financial news that's talking about quarterly earnings. That these are the earnings per share, but this is the market expectation. It outperformed market expectation. Stock price jumped in after hours trading. So one, like we still see these jumps up or down as this information comes out relative to expectation. And two, I guess, I don't know, maybe I'm being naive. I thought that inside information was a little bit more protected than that. That we still, maybe it's just the people who are caught, but people who are caught trading on inside information happens less and less. So I'm curious, like, if you could expand on what are some of the criticisms of strong, efficient market hypothesis or strong form of efficient market hypothesis, and does Eugene Pharma address those?
Well, there's a few criticisms out there, and probably the key one is that even you kind of highlighted that even if markets gravitate towards efficiency, they're not always purely efficient because humans are not purely rational. And this comes down to the standpoint that humans are governed by behavioral and cognitive biases that can persist for extended periods of time. And this can lead to situations where securities can be mispriced there can be a strong differential between intrinsic value and actual value, given that there's these behavioral biases in the masses. And we do kind of see this because the big criticism of efficient market hypothesis is, why do we see these boom and bust cycles if markets are so efficient? Why do things go up so quickly sometimes and then boom back down? And why do things take so long to recover if fundamentals of the economy shows that things should be a lot better a lot sooner, and so on? So that's probably the biggest criticism to efficient markets, the fact that there are these behavioral notions that people need to consider and price in. And that's where a more modern notion of behavioral finance has come into play.
That sounds like I think it's the Keynes quote, markets can stay irrational longer than you can stay solvent.
Right. Well, so that's the counter to behavioral finance. So the notion with behavioral finance is, well, there are these behavioral concerns that lead to mispricings, and you can use that to actually make markets, even though markets do gravitate towards efficiency. But yeah, but my high level counter to that is, just because markets are efficient doesn't mean you, Mr. Intelligent Investor, will know when that efficiency will go away. So first you have to find that efficiency, then you have to know when it's going to go away. And you have to do this with enough predictability to be able to make money. So I fully agree that markets aren't always efficient and that we do see boom and bust cycles, but I think it's really hard to figure out when it's sufficiently inefficient and when that efficiency is going to go away.
Okay, so this is, so sounds like most of the time markets are efficient, and it does not necessarily make sense to pursue either a value or momentum strategy to try and pick an individual stock, because the times where they're not efficient, you probably can't predict when or how they will be inefficient.
Right. And that's the big challenge of having an active type of investment strategy. What you're saying is not that you can kind of figure this out. And what the evidence kind of suggests is that professionals who try to do this, who try to look for these inefficiencies over the long term, don't beat out a passive strategy, a well-diversified strategy that tries to maximize risk-adjusted returns, as Markowitz would have liked.
Okay, so if we acknowledge that value momentum can work sometimes, but most of the time you're better off using a passive efficient strategy because you probably can't predict the times that value and momentum will work. What is the kind of next level of investment theory? So we're now past the 70s and looking at, I believe, asset allocation is started to become more important from the kind of 80s moving forward. You mentioned the idea of just using stocks and bonds and using that for risk-adjusted returns, but when it comes to allocation, asset allocation, what are some of the investing theories there?
Well, so now we're probably in the 80s at this point, going into the 90s. And at this point, academia started to take things to the next level, given the large amount of data out there, and tried to analyze what works and what doesn't, and what really drives performance, what drives returns. And there was a pretty important paper put out there by Brinson, Hood, and Biebauer.
Brinson, Hood, and Biebauer, BHB?
Yeah, BHB, Brinson, Hood, and Biebauer.
Okay.
So this BHB paper, what it did is it deconstructed the performance of portfolios, and it tried to understand across two dimensions, where are the returns coming from? What's driving the returns? And the first dimension is asset allocation, meaning what high-level asset class are you in? Are you in stocks, bonds, commodities, and so on? And then the second decision or second dimension that the returns were investigated across is within that asset class, what particular security were you invested in? And, did you buy IBM or Google, or did you buy this bond or that bond? And what the paper determined is the vast majority of the returns that somebody generates within a portfolio ended up coming from that first decision on which bucket to go into, which asset allocation mix to have. And a very small percent, about 10 to 15% of the returns actually only came from picking the actual securities. And what that kind of tells you is if you want to worry about where your returns are coming from, you better worry about that 85 to 90% and put a lot of effort into making that correct rather than spending all of your time figuring out that 10 to 15%, because you're really not going to move the needle too much if you get the second one right and you completely mess up the first one.
Okay, so now it's just are you 100% stocks or 80% stocks, 20% bonds? That's going to drive your return more than if you're 100% stocks, choosing the right stocks.
Right. And, this is maybe just a nail in the coffin for why trying to predict stocks is not the best use of one's time when it ultimately, according to this research, it's not really what's driving your end returns.
Okay. Wasn't there also a small component of market timing in there? Just kind of when you started investing also impacted your returns?
There likely could be. I believe about 90% of the returns was explained by asset allocation. Actually, it was like 93, 94%. So then we're talking about like a small minority of the rest.
Okay. So did they do research, or have you seen other research that looks at other asset classes that, as they have become available over the last few decades, just things like large cap versus small cap stocks, looking at higher rated bonds versus lower rated bonds, looking at international stocks? How do those play into some of these theories?
Right. So this comes into the bucket of factor-based investing. And what this initially started with is the notion that you could distill a firm's returns down to one key factor. Its component that was related to the market and its beta to the market, its sensitivity to the market movements. And basically, if you knew the volatility of the actual stock in relation to the overall market and how it moved, then you could figure out what you should expect in terms of the return for this particular stock. Now, this was known as the capital asset pricing model.
So you mentioned Eugene Fama. When I hear that name, I think of the Fama French factor models. I think it was started at 3, maybe then it's 4, then it's 5. But where do those theories, because I think those included value and momentum, where do those theories come into play, either based on modern portfolio theory, efficient market hypothesis, or modern asset allocation?
Right. So for that, we probably need to step back a bit to something known as the capital asset pricing model. So this was a model that tried to deconstruct the returns of a given stock and tried to relate it to the market return. And what this theory put forward is that if you know the market return and the sensitivity of a particular stock to the market itself, meaning if the market goes up by a bit, does the stock go up by a bit, or does it go up twice the amount that the market does? That's known as the beta. Well, it turns out that if you figure out this sensitivity to market movements, you can figure out what you should expect for the return for a given stock.
So this would be things like, one example I can think of would be looking at their financials and seeing companies that are similar size, similar revenue. If one has a higher debt balance, they have more borrowing to support that, that might be a riskier company and therefore subject to ups and downs a little more than a company that might have lower debt, lower borrowing, and maybe higher cash balances.
Yeah, so initially, this theory tried to just predict the return of a stock by just looking at the sensitivity of the return of a stock to the overall market. But then people started to look for other factors that might contribute to the return of a stock. And these other factors are, as you had suggested, they were put forward by Pharma French, and they ended up having three original factors where they said, if you look at this initial factor, that's the market factor, that could explain a lot of the stock's returns. But then you could add in two other factors. They seem to realize that small companies did better than big companies. So if you adjusted for that, you could explain even more of a stock's return. And then the third factor was this notion that if you added a notion of a stock having a high book value, meaning a high market price, or a high amount of equity, a high intrinsic value compared to its market price, that could explain more of the movement of a given stock. So looking at these statistical factors, you might be able to come up with a better understanding of how a stock moves. And maybe you could use that to make some money, because if you could take the S&P 500 stocks and figure out which ones had the highest expected returns across these factors and put your money in them, then maybe you could make some money. And this kind of underlied a lot of the initial hedge fund strategies that were out there, in fact.
Okay, so this sounds like there were people implementing what we've already talked about, that idea that it's efficient most of the time, but sometimes it's value, sometimes it's momentum, and sometimes you said it's the book value. No, that book value is value. Sometimes it's the size of the company, and they were actually able to implement these sometimes and able to do so successfully.
Perhaps, yeah. Some of the initial work was actually put forward by a famous hedge fund manager, Cliff Asness, now multi-billionaire from hedge funds, and he actually wrote a paper while he was doing his thesis, I believe in Chicago, but we can put that in the show notes. The paper was known as Value and Momentum Everywhere. And what he kind of tried to say with the paper is, if you took these two simple factors of value and momentum, where we started this whole discussion, and you tried to see which stocks in the S&P 500 had the highest value and which ones had the most amount of momentum, and you put some money in, the top 10 momentum and the top 10 value, and you might make money over time by doing this. And every month you would look at the next best value stocks and best momentum stocks and do that. And in that paper, he looked across all these different asset classes, not in addition to stocks, like bonds, the best value stock bonds and the best momentum bonds, and the best value currencies and the best momentum currencies and the best value commodities and the best momentum commodities. And he formed this portfolio, and this kind of underlied the hedge fund AQR and allowed them to grow to one of the largest hedge funds in history by following this type of strategy. So it's something that has been put out there. It's kind of interesting, though. When I was working at a hedge fund, we actually did replicate these results, and we noticed something quite interesting. We noticed when the paper was published, everything looked good with these value and momentum indicators, but then about 10 years later, if we ran forward those models, and we noticed that the value and momentum indicators weren't doing so well. The curve looked like it was making money, and then all of a sudden it flatlined for like the last decade. And that's kind of what what we saw showing up in the actual performance numbers of AQR. And what might have happened is maybe something like this worked when you have 100 million, 200 million, couple billion, but once you get $100 billion invested in this, can you really pull out that type of advanced or superlative returns from a strategy like that? And that we kind of said, maybe it's not something that scales. And that's kind of the fundamental issue with hedge fund strategies in general. They try to look for these types of trends or patterns, but if you try to scale them too much, they could disappear.
I actually would have guessed that once they publish the paper, others will start replicating the strategy, and like our arbitrage and efficient market hypothesis discussion earlier, once enough people are doing it, the opportunity is no longer there. Like once you find that slightly undervalued company that shows that promise, enough people bid up the price that the value's gone. Or if you see the momentum trend going and people see it going up, they all buy in, but it like accelerates it faster than the trends would have said, and then it turns back over before they can realize that. So that would have been my guess, that just enough other people using the same strategy, or maybe even like you said, coming up with the same research on their own or independently, either after his paper and confirming it, or they just didn't happen to get there first. So that would have been my guess as to why the strategy may not have worked. But the ability to scale also makes a lot of sense, because I have seen that for other strategy, other funds, that once they get too big, they can't make those buys and sells without their actions influencing the market and almost undoing what they're trying to get into.
Yeah, you're absolutely right. And what you mentioned is basically a different side of the same coin. It's the notion that eventually enough people, whether you do it to yourself or other people do it to you, will pile into a trade and make it so that you can't make money off of it. And that's why these strategies are so hard. And that's kind of why active management is so hard. It's a constant cat and mouse game. And you always have to kind of stay ahead of the next guy. You always have to add either more horsepower, be closer to the exchange to make your trade more quickly. Co-locate is something that was big, meaning you set up a server directly across the street, so your fiber optic cable is shorter than everybody else's. And guess what? Everybody else does the same. And you have this kind of nuclear arms race to zero in terms of being able to outperform, so that not only can you not get dollars anymore, you can't get cents and you can't get micro cents. And at the end of the day, it's kind of like a zero-sum game where it's hard to make a winner out of it.
I think that was a Michael Lewis book. I think was that Flash Boys?
It could have been mentioned there.
The story of just like getting closer to the exchanges.
Yeah, that was mentioned there. Yeah.
Yeah. I think even one story was someone illegally interrupted a cable coming from Europe so that they could delay the information coming from Europe just enough that they had it and they could act and trade on it before anyone else would. And the delay was on the scale of seconds or microseconds, so no one actually noticed.
Right. I'm kind of reminded of this movie that came out in the early 80s. I'm kind of dating myself here, but it's called War Games with Matthew Broderick. Yeah. And if you recall the premise, basically the government had this supercomputer that was designed to figure out when we should go to nuclear war or not. And the computer kept saying war, war, war. And then, this kid, Matthew Broderick, comes in and says, well, I'm butchering the plot because I haven't seen it in a few decades. But the kid basically says, well, what if we let the computer play itself and see what happens? And the term nuclear arms race is the notion that if you have two guys competing, you end up in a stalemate, a Cold War. So yeah, in this movie, War Games, it was during the Cold War, and you had a situation where the US was against Russia, and both sides were building up arms. They had an arms race, and with an arms race, the concern is each side has to have more arms than the other side, meaning they build more bombs, we build more bombs. And all of a sudden, to keep up with each other, you just keep adding more and more to each side's nuclear arsenal so that you're at the point where if any side reacts, you're guaranteed that each side will blow each other up. And what the computer still wanted to do before Matthew Broderick came into the picture is it just wanted to go to war. It wanted to keep sending missiles over there. So what Matthew Broderick did is said, okay, computer, how about you play yourself? It's you against you, and let's see what happens. So the computer started all of these simulations trying to fight itself, and it went through every single permutation out there, and it just concluded the best way to win this war is to stop playing. The best way to survive is to not play the game because you're mutually going to assure destruction if you try to. And that's what I see with the markets. If you try to play this game of continually trying to outsmart the other character, you're just going to keep adding more time and resources, and you're probably going to be left with a stalemate. And that's why I feel like even though it's so alluring to be able to beat the markets, it's probably a game you don't want to play.
I do like that analogy. That's a great message to kind of wrap up on. Before we end for today, do you want to add any final thoughts?
Well, I think we covered a lot of ground here, and we probably set ourselves for another episode or two because it's a big topic, and it's probably something where if you don't understand the nuances, there's a lot of allure on Wall Street, a lot of fancy products, but at the end of the day, if you look at the research, it might say a completely different picture than what you might see on a page that's trying to sell you a financial product.
That is so true, unfortunately. Okay, well, thank you for really giving us a good education on this, Trishul. I really do appreciate it, and I'm sure we're going to have lots of show notes that have papers, dates, and authors.
Right, yeah, this might be a big one, but I enjoyed the conversation, Aaron, and thanks everybody for listening. If you like what you hear, do subscribe to our podcast. Thanks, everybody. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.